Kingfisher is a multinational group consisting of retail banners such as B&Q and Screwfix, operating in 8 European countries including the UK and France, with 1,370 stores and 78,000 employees. The home improvement industry worldwide is extremely competitive, with the highest sales figures in the world coming from the Home Depot, equaling $110.2 billion. Despite being $95.3 billion behind this in 2020, Kingfisher boasted the fourth highest sales worldwide in the home improvement industry, amassing $14.9 billion for the year. The first ratio that has been calculated to assess the financial position of Kingfisher plc is the current ratio, comparing the company's current assets to their current liabilities. In 2017-18, Kingfisher had a current ratio of 1.15 to 1, which rose to 1.28 to 1 in 2018-19 before falling to 1.12 to 1 in 2019-20. This industry average for this ratio is sitting at 1.27 to 1, meaning that the current ratios that Kingfisher has been able to record are at a good level and should not cause too much concern. The second calculation to analyse the company is the PE ratio, looking at prices and earnings per share. Kingfisher had a PE ratio of 0.16 in 2018 due to a low share price as a result of low pre-tax profit, rising to 21.6 in 2019 and rising further to 510 in 2020 due to low earnings per share as a result of the coronavirus pandemic. On the other hand, Home Depot have been able to maintain a relatively steady PE ratio, equaling 24.14 in 2018, 22.02 in 2019, and 25.76 in 2020. The corporate governance structure allows the Kingfisher board to be split into committees to allow individual members to oversee decision-making across a number of principles. However, within the annual report, while the board composition is under review constantly, Kingfisher does not consider other governance structures, meaning that their current structure may not be the most efficient. Kingfisher's director has released a statement in the 2019-20 annual report with three main governance themes: the company's response to COVID-19, the appointment of a new CEO, and their responsible business pledges. The reason for this statement is to allow the director to update the workforce on company performance from the previous year. In terms of shareholders, 75.88% of the shares issued by the company are owned by financial institutions, and 0.52% are owned by people within the company. The inclusion of financial institutions as investors is beneficial for Kingfisher, as external investment leads to more monitoring as these investors look to ensure they are benefiting financially. In addition to this, Kingfisher are looking attractive to external investors as they come out of the pandemic due to sales pickup and increased third quarter revenue, meaning they are able to repay business rates relief they have received. Throughout the Kingfisher 2019-20 annual report, the company outlines all of the governance provisions that they comply with, acknowledging they do not comply with one because of the company's own remuneration policies. The company also outlines how they aim to reduce any possibility of agency problems, using share options to incentivize their managers to prioritize company performance above their own interests. Kingfisher also invites external auditors into board meetings in order to oversee decision-making and financial reporting to ensure that all decisions made are fair. On this slide are the calculations used to assess the risk and return of investment in Kingfisher. The average rate of return can be seen at 0.309, comparing to 0.373 for the FTSE 100 market as a whole, meaning this figure shouldn't cause too much concern, however could be improved. The covariance of returns between Kingfisher and the FTSE 100 measures a directional relationship between the returns of the two variables, with the covariance between these variables equaling 44.255, meaning there is a general uptrend in returns. In addition to this, the correlation coefficient has been calculated between Kingfisher and the FTSE 100, equaling 0.0524. What this means is that there is minor evidence that these two assets would move in the same direction, increasing the risk of a portfolio including these two assets very marginally. The final measure of risk calculated is the beta of Kingfisher's shares, which measures the volatility of a share in comparison to the market. Kingfisher's shares have a beta of 0.0166, meaning that these shares are much less volatile than the FTSE 100 market as a whole. This slide shows the same measures calculated for one of Kingfisher's competitors, B&M. Comparing these figures to those of Kingfisher, B&M's average rate of return is much lower, sitting at 0.114, which is a big positive for Kingfisher as they are looking more attractive than competitors to potential investors. The covariance between B&M shares and the FTSE 100 market has been calculated as well, equaling 77.122. The higher covariance than that of Kingfisher and the FTSE 100 means that there is a stronger uptrend that can be seen between these two variables, which can increase risk in a portfolio. Another measure of risk, the correlation coefficient, has been calculated, equaling 0.0961. This higher correlation coefficient means that the asset returns are likely to move slightly more in tandem with the market as a whole, which can increase risk further if the market performs badly. The beta of B&M stock has also been calculated, which sits at 0.0289. This means that while the stock volatility is still low, it is very slightly higher than Kingfisher's, meaning the asset will mirror the movement of the market as a whole slightly more closely than Kingfisher stocks. In conclusion, one of the main goals of many businesses is to maximize the wealth of their shareholders. One way that Kingfisher has not succeeded in this goal is through their decision not to issue any dividends for the year as a result of the COVID-19 pandemic and the financial impact of this. However, on the other hand, many business decisions from the past year have looked to accomplish this target. The new CEO has looked to streamline business operations in order to reduce costs and boost profits, and the commitment to the responsible business principles is looking to ensure the company are seen as an ethical business, emphasizing public perception which will lead to more sales. In addition to this, there are no serious agency conflicts evident in the annual report. One area of possible conflict could have been the decision by Kingfisher to close all stores despite being classed as essential. This would have had obvious detrimental financial effects. However, the company did rush through their online delivery service in order to ensure their business could still operate, thus reducing the conflict here. Finally, there are some positives and some negatives for Kingfisher to look to in the future. As the world comes out of the current pandemic, Kingfisher are in a positive position, being able to repay business rates paid to them due to increased revenue, making them attractive to external investment. As well as this, their decision to cement their responsible business commitments will increase trust and loyalty within their customer base, bringing positive business with it. On the other hand, uncertainty surrounding British business post-Brexit means that Kingfisher could face higher business costs in their French, Polish and Romanian stores, as new taxes and legislation come into place dictating the move of goods. In addition to this, ever-increasing competition within the market, coupled with Kingfisher's haste to ensure delivery for online orders, could bring adverse consequences if problems arise and competitors can offer alternatives.